Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at Apple stock and seeing if it's time to maybe consider buying Apple after their earnings, despite all of the ongoing coronavirus fears. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so before we jump into Apple and see what to expect and some more of the company's fundamentals, I want to take a quick look at the broader earnings picture to give people a sense of what's going on. And obviously, we'll quickly talk about some stock movement as well. So U.S. stocks fell on Monday as Wall Street investors decide what's next as more countries around the world start to slowly try to reopen their economies. And I don't really want to turn this into a speculative coronavirus episode because no one really knows what's next and no one really knows when things will return close to quote unquote normal. So instead, we're just going to look at some of the relatively gloomy earnings data. So as of Friday, our Zacks estimates had, we've seen Q1 results from 434 S&P 500 members. So about 87% of the index's total membership. And of these companies, so of those 334 index members who had reported as of Friday, May 8th, earnings were down about 10.6% in the first quarter from the year ago period on 1.1% higher revenues. And then if we look ahead, things appear to be even worse, as you might expect, since the big coronavirus downturn didn't really start to happen till about mid-March. So hopefully we'll see the full impact of the coronavirus economic shutdown in the second quarter, with things slowly starting to bounce back in Q3 and Q4. So based on our current data, Q2 earnings are expected to fall 40.4%, so over 40% from the year ago period. And these estimates have come down pretty quickly, pretty fast. So I'm looking at our chart from our Director of Research's report last Friday, Shiraz Mian. And so as of if we're looking at March, so as of March 25th, we were calling for, actually, I'll jump back even further because this helps paint a better picture. So on February 5th, we were calling for Q3 earnings or Q2 earnings to climb 3%. So that was February 5th when the coronavirus was more of just a thing happening in China, some broader worries. And then by March 25th, we were calling for earnings to fall 5% in Q2. And then by April 24th, we were calling for Q2 earnings to fall 32%. And now we're calling for the earnings to fall over 40%. So it's happened really quick, and these estimates could continue to go in the wrong direction as more and more companies provide some better guidance. So then overall, we're calling for Q2 or overall fiscal year 2020 earnings to fall over 22% on 5% lower revenue. So obviously the broader earnings picture looks a little bleak in Q2 and overall in 2020. And then at the moment, we're calling for things to quickly recover in 2021, but it's pretty uncertain, and we don't really have that much knowledge of what's going to happen, since we don't really know what's going to happen in the near term. It's kind of hard to project all the way out to 2021. So what we do know as of the moment is that the Q2 picture looks pretty bad, and that's going to push down overall fiscal 2020 earnings in a pretty significant way. So despite some of this negativity, though, sectors such as energy, transportation, and consumer discretionary spending, among many others, are expected to take massive hits, while some other sectors have proven to be more resilient so far. And tech has continued to prove its resiliency. So Q1 earnings are actually up 6.2% for the S&P 500 tech sector on 4.2% higher sales. So we've already seen the likes of Facebook and Google and Amazon and Netflix and Microsoft prove their resilience to the coronavirus as much as maybe any other sector, these big tech players. And Apple proved its resiliency, even though it's taking some significant setbacks in China and elsewhere because of its consumer-facing products. But we're going to dive into why investors might want to consider buying Apple stock today, despite all of these setbacks. So before we dive into what's going on in the future, or what we expect in the future, we're going to take a quick look back to February 17th, when Apple warned Wall Street that it was likely to miss its revenue guidance due to production and demand setbacks in China. Apple since then has slowly tried to get back to something close to normal operations in the world's second largest economy, and its stores remain closed throughout the US and most other markets. And the Wall Street Journal has reported recently that it's pushing back the production ramp up of its flagship iPhones. They're expected to come out later this year, so they're pushing that production back by a month as of this report. So those normally come out in the fall, so that production could get pushed back to be maybe in the early winter. And this is obviously a very, very fluid situation. Apple also didn't provide revenue projections for the current quarter for the first time since it started to offer up what it would consider as true sales guidance all the way back in 2003. So that's another sign of the really uncertain times we're in at the moment. And with that said, the tech titan still clearly faces the potential for more possible setbacks and reduced demand for its high-priced iPhones and other consumer electronics, as we're really in this broad unknown at the moment with millions of Americans losing their job. But we're going to try to not speculate on how bad things are going to get, and we're going to see what the numbers tell us at the moment. So Apple topped our Q2 estimates and on both the top and bottom lines at the end of April, and its second quarter fiscal 2020 revenue actually popped about 0.5% from the year ago period to over $58 billion. Apple, in their press release, rounded that figure up to 1% because that looks a little better. For reference, Apple's Q2 revenue topped our estimate by about 9%. So a solid top line beat. And the expansion of its non-iPhone business really paid off once again. The firm's services unit, which includes its app store, its new streaming TV offering, and a lot more, saw its revenue jump about 17% to a new all-time record. And then on top of that, its wearable division surged 23% for the quarter, which was driven by continued strength of its wireless AirPod headphones. In all of this growth, so the growth in services in its wearables division helped offset what was a 7% downturn in iPhone sales, which still accounted for about 50% of total Apple second quarter revenue. So the iPhone is still a key revenue player, and it'll be interesting to watch what happens with those iPhone sales throughout the rest of fiscal 2020 for Apple. So then we're going to move on to the bottom line. So Apple's adjusted earnings climbed about 4% to $2.55 per share, which easily beat our estimate. And the company's operating cash flow also jumped by $2.2 billion to $13.3 billion. And the company ended the quarter with $193 billion in cash, alongside about $110 billion in debt, which left it with about $83 billion in net cash. So they're sitting on a ton of cash. As most people know, Apple has lots of money to work with, and investors should be pleased to note that Apple raised its quarterly cash dividend by 6% to 82 cents per share. Its next dividend will be payable on May 14th to shareholders of record on May 11th. So that's actually as of today. And Apple's current dividend yield rests at about 1.06%. So this tops the 10-year U.S. Treasury easily and compares pretty favorably to Microsoft's, which is that other trillion-dollar tech player who investors also consider as kind of a safe haven from the coronavirus. On top of that, Apple's board, and this is another key point, Apple's board authorized a $50 billion increase to its current stock buyback program, which is great news for investors. And it also really just shows how strong Apple's balance sheet is, and prove that its management remains confident despite any near-term setbacks. And it also stands in contrast to other big names in tech and big names in general, such as AT&T, who have suspended their repurchase programs during all of this coronavirus uncertainty. So amid all of this uncertainty, Apple's going to continue to buy back stock, which is going to return value to shareholders and really just prove how strong of a company it is. And now if we look ahead, our current Zacks estimates, I'm just going to call out. So for the current quarter, which is their Q3, we're calling for sales to drop about 5%, and then another 5% in the last quarter of their fiscal year, which is the quarter before the holiday period, for broader market sense. So overall, we're calling for their 2020 sales to pop about 1% and then jump about 14.5% that next year. But all of these estimates are still pretty up in the air. And then we're calling for the bottom line to slip about 11% in the current quarter and then 8% that next quarter. But still overall, we're calling for the full year to be up about 3.5%, and then another big jump on the bottom line, up 23% in 2021. But as I mentioned with the top line, these estimates are still kind of up in the air. So it's more just focused on how strong is Apple's core business, and these estimates can be a little fluid as we know more and more going forward. With that said, Apple stock, as much of the market has, rallied pretty heavily from its March 23 lows. It's now up about 7% overall in 2020. It popped another 1% through mid-morning trading Monday to around $313 per share. So about 5% off its 52-week highs. So it's really rallied big since its March 23 lows, but it still sets about 5% off its highs. Over the last year, despite this big coronavirus downturn, Apple stock is still up about 67%, and this compares to the S&P 500. It's about 4% climb over the last 12 months, which includes the big sell-off and the bounce back. So this is where some investors are starting to get a little nervous that it's the recoveries happen very quickly, and that Wall Street and investors are looking a little too far ahead because we don't really know that coronavirus impact. So we could see a bit of a pullback in that sense. But anyone who's thinking about Apple should maybe be thinking about it as a longer term investment anyway. So if you look back in 12 months from now, is Apple at $313 per share going to look like somewhat of a steal compared to maybe where it's going to be trading in 12 months or 3 years from now? That's probably a solid bet. And then if we look at the valuation side, Apple's trading at about 4.7 times forward 12-month sales, which is above its industry's average, which Apple's continually traded at a premium compared to its industry's average, but it's still trading below its highs, as one might expect, as the stock sits below its highs. It's obviously above where it's traded at recently, but compared to another big $1 trillion tech stock that we've just talked about quickly, Microsoft, it's actually trading at a pretty significant discount, as it has for the last several years in terms of forward 12-month sales. So Microsoft's trading at about 9.1 times forward 12-month sales, and Apple's trading at 4.7. So a solid discount on Apple's side in terms of what investors are willing to pay for that forward 12-month sale. So in the end, it really does seem like Apple is one of the safer plays on Wall Street during the pandemic, even though it's a consumer-facing company, and some investors might want to look to Microsoft instead, or Amazon, or some of the other big tech players that aren't reliant on high-priced consumer tech. But the results were better than expected going forward. And as we mentioned, even if Apple shares do pull back in the near term, longer term, investors might want to consider buying Apple stock as just really one of the safer plays on Wall Street. Or you could look into some ETFs which track the tech industry in general, which Apple might play an outsized role as it's such a big company. So overall, it's definitely worth considering Apple or some of these other big tech players amid all of this uncertainty, because as we noticed, the earnings picture looks pretty bleak, but the tech sector, among a couple others, has been so far kind of a bright light in this really dark times for the global economy. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.